Welcome to chapter 23. What is a preferred share or a preferred stock? In this chapter, we are going to learn about what a preferred stock or a preferred share is, and then we are going to learn what are the things to consider before buying a preferred share. So let's get started. A lot of people, they really don't know what a preferred share is. They have heard of it, but they really don't understand how it works. So that's what we are going to cover in this chapter. Specifically, we are just going to go through the fundamentals of the preferred share. So when you look at this chart, you can see that the lowest risk that you are going to have on any investment is a bond when you're dealing with stocks or bonds. The preferred share is actually right in the middle on the risk, and then the common shares which I have talked about up to this point in our previous chapters has all been common shares. So a preferred share is actually a kind of the in the middle as far as actually owning some of the equity of the business. But the preferred share performs like a bond. So as we go in the next slide, you are going to kind of see how that works. But as far as the thing that you are going to really understand, as far as the risk is there, the preferred share is not as risky as owning common shares. But it's definitely more risky than just owning the bond of a company. One of the unique things about a preferred share, a lot of people would think that it would operate and have a lot of the same fundamentals as common share, but it actually operates a lot more like a bond. So whenever you buy a preferred share, it's instead of having a coupon, it's going to have a dividend of preferred share, which is a proportional piece of equity in a business. Now, what will confuse a lot of people is your piece of that business, your equity of that business is only going to come about if the company would liquidate. So, that proportional ownership that you own of that piece of business really is not doing anything for you as far as like the market price of that preferred share changing unless that company would liquidate. That's whatever left, if not all the money would go to the bondholders, and then whatever the money would be left would then be paid to the preferred shareholders, and then any money that be left over after both the bondholder and the preferred shareholders would be paid, then go to the common shareholders. So that situation, in my opinion, is very unlikely. If you go through a liquidation of a bankruptcy for a business, pretty much the bondholders are the only ones that are going to be able to get anything that remains in the business. So that the share of equity that you are actually getting with the preferred share, in my opinion, really is not worth anything. Because 9 times out of the 10, if a company would go bankrupt and liquidate, all that money is going to go to the bondholders. The preferred shareholders and the common shareholders are pretty much going to lose everything at that point. So, how does a preferred share work? As you can see here on the left hand side, I have a bond. We are just going to call this company A. So, one bond of company A. We are going to say that the term on the bond is 30 years. And if this terminology is not making sense, I strongly encourage you to go back to my previous video, day 7, what is a bond, day 8, what are the components of a bond, and day 9, bond valuation and yield to maturity videos, and all these will be crystal clear after you learn those lessons. So please go back and take a look at those if these terms are not making sense to you right now. Let's say on the left hand side we have a bond. The term is 30 years. Face value is $1,000. Coupon is $50. So our yield based off of those figures would give to 5%. Just like that, let's say we have a preferred share of a company A on the right hand side. Just say that the term on the preferred share is 30 years. Face value, instead of it being 1,000, is only $50, and it pays an annual dividend of $3 a year. And so when you take that dividend and divide it by the face value, you would actually get 6% yield. So this preferred share is very much like the bond. It has a term, it has a face value. Instead of a coupon, it now has a dividend. The nice thing about preferred share is it's cheaper price than the $1,000 for the face value on the bond, but it's operating exactly to the same fundamentals. Now, in real life, a lot of preferred shares don't have a term. They will not have a term of 30 years or 10 years. They are like never ending interns. This scenario is just an example. It's much more common to see a perpetual preferred share, meaning that they will issue it. I mean, the company will issue it and it's out there, and then they decide to terminate the preferred share by buying back. So you can't find preferred share with term limits on them. So how does it work? So the first thing that you have to understand whenever you are buying a preferred share is that you have to read the certificate of designation. And that certificate of designation describes all the intricacies of how the preferred share works and operates. Like I said before, in this example that we used for company A has a term of actually 30 years. And then the company is going to go ahead and buy that preferred share back from the holder, but that's not always the case. As you look at one company's preferred share to the next, it can be completely different. The way that it operates and all of that information will be found in this certificate of designation. So if you are interested in purchasing preferred share, this is something that you really definitely going to have to become familiar with and understand before you dive into something like this. Then you have got to understand that preferred shares are not a real big market. You have got a lot more bonds in the market, a lot more common shares in the market than the preferred shares. So to understand how a preferred share works, you really got to understand why a company would want to issue a preferred share. Kind of picture yourself as being a CEO of a large business, and a lot of times you will see preferred shares issued on a new IPO type companies. They're just going public, that really need to raise some money, and so the beauty of the preferred share from the CEO's perspective and from the shareholders perspective that currently hold the company is that they can raise a lot of money by issuing these preferred shares, and they have the flexibility to set up that those certificate of designation. They can actually have the verbiage in there so that they can delay their dividend payments, even though that they say they are going to make a fixed dividend payment of, let's say, 6%. They can actually delay that and let those dividend payments accumulate and then pay them later. Some certificates of designation will actually have writings of the verbiage there that the company does not even have to repay the dividend. It is just really kind of goodwill to the person who purchases it. So that's why you really need to read that certificate in order to understand how that verbiage is. If you are the company issuing these preferred shares, that's a great thing because now you have the flexibility and the privilege not even to make the dividend payment to that person who is holding it. So that gives a company a lot of flexibility. And also, this is the real reason. And it's because the company can retain its equity of the business for those common shareholders. So think of this way: if you are a common shareholder of a business and you want to raise some money, but you don't want to give up the equity that you currently possess of the business, issue some preferred shares, because although that the other person thinks they have got some equity of the business, the only time that the equity is going to materialize is if only if the company would liquidate or fail. So let's say you issued a 6% preferred share out of your company to raise some money, and interest rates went down to like 4% and they are much lower. Well, you will obviously want to pay off that holder of the preferred share, which you would have that set up in your indenture, so that you can do that. So you pay off that preferred share, issue new ones at the lower interest rate, so you are not paying such a high interest rate to the holder. So you have that flexibility to immediately pay off that preferred shareholder, and all that equity immediately disappears whenever you buy that preferred shares back. So really, the equity that you are seeing, you are not seeing any growth in the market price or anything like that, because the market price is going to be completely dependent on the interest rate alone, just like a bond. So what are some other things that you might see in this certificate of designation? The first thing that I want to bring up is the cumulative preferred shares versus non-cumulative preferred. A cumulative preferred, you will eventually get your dividend, but you might not have the ability to compound a consistent dividend payment. But at least you are getting that payment. So in this scenario here, where the dividends of $3 for company A, if the company can't make the payment and they skip that payment, the dividend payment, they eventually have to make that payment. They have to pay you the $3. So maybe your next dividend is $6 as opposed to just $3 because they have to make that up. Now, whenever you see a terminology in the certificate of designation for a non-cumulative preferred, that company does not have to pay you the dividend. They are most likely going to pay the dividend, but they don't have to. And that's something that you got to really be careful of. And I would never ever buy a preferred share with a non-cumulative preferred dividend payment. I briefly talked about the term and how many preferred shares are perpetual preferred shares, meaning never ending, and it has no maturity date to it. So that company can issue that preferred share and it can stay out there for as long as they want, and they can just keep making those payments to you. So if you buy a preferred share and has a very low interest rate, you might be holding on to that for a really long time. And unfortunately for that person who would buy a low interest yielding preferred share because it has no term to it, it's not going to then rise back up to that face value of $50 for this generic share we have here. It might just sit down there at $35. So you might buy that preferred share for $50 and interest rates start rising from where you bought it. It might sit down there in a market price of $35 forever as you continue to hold to it, because there is no exit strategy for this type of person that bought a preferred share without a term. So there are two learning points. Either make sure you buy one that has a term, or make sure you don't buy a preferred share with a really low interest rate and you avoid that scenario. Okay. So the next thing that you got to be aware of this is the callability of the preferred share. You are pretty much always going to find preferred share with a callability class in the certificate of designation. So that's something that you are going to have to work with. If you buy a preferred share with a really high yield, let's say you are buying a company at 10% or 8% and it's fairly decent company, they don't have enormous amount of debt, you can pretty much expect that that's going to get called. So when you buy that, you just kind of go into that anticipation that you are going to be get called on that, and that they are going to pay you back your initial purchase price or the face value of that preferred share in order to stop paying you that high interest rate. So that's just something that you have to be ready for. Most preferred shares have an adjustable dividend rate. Now I told you that it was a fixed dividend rate at the beginning of this video, but depending on how that certificate of designation is set up, you might actually purchase a preferred share that has an adjustable dividend rate. This is something that you really want to avoid. So in summary, when you are buying a fixed income security or a preferred share, you are trying to find something paying a high dividend. You are trying to get something that has a high yield and that is fixed, because that's what gives you the leverage for whenever the interest rates drop to sell that at a nice premium. So then you can use that and go and buy your common shares. A quick recap here. What we are looking for when we are purchasing a preferred share: one, you absolutely have to read that certificate of designation and understand all those basic fundamentals that I just discussed. You definitely want to buy a cumulative preferred share because that's going to guarantee that you are going to go ahead and get that dividend payment, and you want to avoid, if possible, the perpetual terms, meaning never ending terms, because that's going to allow you to have an exit strategy that's going to allow you to have the market price eventually go back to the face value of what the preferred share was issued at, and you are just going to have to be aware of that callable security. So this concludes day 23, what is a preferred share or a stock, and in this chapter we learned what a preferred share was, and we learned what are the things that to be considered when purchasing a preferred share. Thank you and see you in the next chapter.